In times of uncertainty, the challenge for investors is to find a strategy to cope with changing economic conditions. Richard Woolnough of M&G is here with us to look at the optimal allocation. Richard, good afternoon.
Good afternoon.
And welcome to Geneva.
Thank you.
So, Richard, your management is quite unusual for a bond fund, at least seen from a European perspective. Can you explain a little bit the diversity of your allocations?
And the Optimal Income Bond Fund is a fund that's a lot more wide-sweeping, dramatic in what you can do in the bond universe. At M&G we have bond funds that specialise in high yield, emerging markets, investment grade, government bonds. And the concept behind this is to have a free-ranging corporate bond fund that if high yield is the most attractive asset, we can allocate towards high yield. If investment grade is more attractive, we can go towards investment grade. And if government bonds are more attractive, we need to be defensive and go towards that. So it's a very wide-ranging fund. It's got a huge palette in terms of the assets we can buy in the bond world. And with that, we have the flexibility of using other instruments to implement our credit views and our duration views in the most efficient way we can in this wide-ranging mandate.
That means you also include equity in your fund?
Yes, it's a little bit different in Europe. There's been a tradition of bond funds in the UK, high-yield bond sector, having an element of equity in there. The investment philosophy behind it is that quite often we find that the income that's generated from the equity part of the capital structure is better value than the income that's generated from the bond part of the capital structure. And that's what drives us to sometimes, on a stock-specific basis, finding equities that provide a better long-term income stream than their bonds would of the same capital structure. From a risk point of view, I think the way that investors get more comfortable when we talk about it is that if they're comfortable owning high-yield bonds, and high-yield bonds are quite often equity-like in their characteristics, then as an alternative to high-yield bonds, we find equity can be attractive. So on a stock-specific basis, equity can be attractive versus the debt of the company. And when you look at the overall asset allocation, if a fund is prepared to take equity-type risk through owning CCC risky high yield, then from a risk perspective, they should be relaxed about looking to maybe use equities when equities themselves are cheap versus high yield, which they have been at various times over the last few years.
Sometimes they're preferable in times perhaps of buybacks.
Yes, I mean that's a classic way to think about it. It's not just us as investors are thinking, is equity cheap versus debt? The company themselves are thinking, is equity cheap versus debt? So examples last year will be Apple issuing bonds. Why do they issue bonds? They got plenty of cash. They issue bonds to buy back their equity. So if the management of the company, the advisors and the finance director think, hang on a second, we should be issuing bonds and buying back equity. As an investor on the other side of that trade, do I want to own the bonds that they're supplying, which will go down in price, or do I want to own the equity that they're buying that will go up in price? So if the valuations are fair and decent, that encourages us to look at equities occasionally versus debt.
Where is your portfolio at the moment in terms of duration and credit risk?
I mean, the first driving force of any bond portfolio is duration. We are still short duration. We're less short than we were this time last year. Bond yields were less attractive. We're a value investor. As bonds get nearer and nearer towards a fair value, then basically we start looking to our duration. At the moment, a neutral position on our fund is a 5.5 years duration, which is quite long for a traditional European bond fund. And we're currently positioned at 3.6, 3.7 years duration, so a little bit short. If bond yields get back towards 4.25, 4.35 in 30-year treasuries, they're a little bit below that at the moment, then we maybe look to add some more duration to our funds.
And you do that using futures?
We do a mixture of things. If we can find the physical bonds we like, we'll do it. If we can do it via futures, we can do it. And we can be very specific. For example, the last time there was a sell-off in the summer on the back of the tapering stories, we found the best way to get longer duration in the US was to buy 5-year futures. So we used the fund to buy 5-year Treasury futures, an area that got badly hit in that sell-off. And that seemed to be a far better way to express our duration view than the traditional thing of buying the longest thing you can, which would be a 30-year bond future.
Although you sometimes buy very, very long bonds, such as the EDF one.
Yes, we do buy some very long bonds, and when they're cheap and when they look good value versus their shorter dated bonds, then we're very, very happy to get involved in those bonds. We look at the duration, look at the cash flows of those bonds, and quite often there can be value in there in those underlooked areas of the market.
The world seems to be going back to normal, and there is, of course, expectation that interest rate will rise. What impact will it have on your portfolio? What are your views on this?
Like any bond fund, if interest rates go up, it'll depress the value of the fund. The question is the pace. And if you have a very, very slow return in interest rates, then the extra income you receive through lending for term compensates you for the slow capital erosion you get as interest rates slowly go up. If you have a very rapid increase in interest rates, you receive that extra income for a very brief period of time, and that's not enough to compensate you for the capital loss. I think the world is going back to wherever the world can be. The world is going back to a different state. It will look more like it used to do before the financial crisis, but I think it has changed forever. I think the bank system has changed, the market has changed, and therefore, that normalisation of interest rates, if it does occur, I think will occur at a slow pace, and I think rates won't go back to traditional 5, 6. They'll more likely to go back to traditional 2.5, 3.5 in terms of short rates. I think the system has fundamentally changed. The shock to the system from the banking crisis means that the economic system is going to operate in a different way for the next 10 years than it did the 10 years before 2007.
Well, Richard, thank you very much for joining us today.
Thank you very much. Thank you.